Hello, everyone. This is Dr. Wang speaking. Today, we are going to move to a new chapter, chapter 3. This is on the second module of the Canvas on our course plan. So, if you go to my SXU, you log into the Canvas, we have a finished overview of finance. You should have finished that before you move to this video. And now we are moving to this second module, financial statements and ratios. And that module basically covers chapter 3 and 4. And also you are going to do a report on a case study, which is called Planet Popcorn. That's a company in California. And also, after this module, you should be able to finish the Excel project, okay? So you have the project instructions right here, the Excel work file you can start work with, and also all the video links right here, okay? You can see a lot of videos. Don't get scared because each of the video may just last for 2 or 3 minutes, and 5 minutes tops. So although you are looking at a lot of links, but actually when they add up, they are not that long. Okay. I'm not covering chapter 2 of the textbook. Okay, you can see chapter 1 and then jump to chapter 3 and 4. Chapter 2 is not covered because the content of chapter 2 is the financial market and the financial institutions. And in later chapters, I will cover these subjects and topics. So, which means chapter 2 will be distributed nicely in later chapters for stocks and bonds and also risk and returns. All right, so let's just move to this PowerPoint file. So basically, this is financial statements, and you have been exposed to that in your accounting class. Okay, so let me just view this. Okay, the basics of a financial statement, you have three major types of financial statements. These are balance sheet, income statement, and a statement of cash flows. And you also have a statement of owner's equity, but for this chapter, we are not covering that. We just mainly focus on the interrelation between these three statements. Okay, so on the company's annual report, and first of all, we're talking about public companies like Coca-Cola, Nike, Ford, and these companies have their stocks traded publicly in the stock market, okay, like a New York Stock Exchange or NASDAQ. And by law, they're obligated to disclose their financial information to the public, so the investors can get to know the company, decide whether to invest in that company. And when they disclose the financial information, either on an annual basis or a quarterly basis, so you shall see the income statement, which summarizes the firm's revenue, and you deduct revenue, you deduct costs, depreciation, interest expenses, taxes from the revenue to get net income. So that's the income statement. And the balance sheet basically provides a snapshot of a company's financial position at one point of time, like the company's total assets, total equity, and the total liabilities. And the income statement basically record the entire activity, all activities for a given period for the whole year. Okay, so you may make $1 each day, and then at the end of the year, you make $360. So on the income statement, you have $360 sales. Okay, and the balance sheet, however, reports to a snapshot. Okay, just at one point of time. So, for example, you have a building at the end of the year that is worth $300,000. Okay, so that's $300,000 on total assets. Okay, and the next day the building may disappear. You may sell it. It may be worth zero on your book. So, but it does not matter. You just want to report on that point of time. If you have it, you have a 300,000. If you don't have it, you have zero. Okay, and then the next financial statement is called a statement of cash flows, and that reports the impact of firm's activities on cash flows over a given period. So you have a lot of items on the balance sheet, like cash, like inventory, account receivables, and payables, and they all change from time to time. All right. So let's say if your inventory increases, assume no other things happen, then that basically would deplete your cash because you have to spend money to build up that inventory. Okay. So that's one